Welcome to this explainer. Today, we're diving into exactly why the global market is bracing for impact, and more importantly, how you can shield your own financial future. We constantly hear these alarm bells ringing about the economy, but today, we're going to look right under the hood to see what's actually happening. By the end of this, you'll know how to build an absolute fortress around your personal wealth. So let's just start with a question that affects every single one of us every day. Why won't mortgage rates fall? And why do stocks seem to just randomly freak out every few months? We usually point fingers at politicians, right? Or maybe local policies. But actually, scratch that. The answer doesn't start in Washington. It starts in Tokyo. Here's our roadmap for this explainer. 1. The hidden global threat. 2. The yen carry trade. 3. Bracing for economic impact. 4. The math of wealth. And 5, 3 phases to a million. We're going to zoom all the way in, from a hidden global threat down to the immutable math of your personal wealth. Section 1. The hidden global threat. Japan's bond market. Okay, so for the past 30 years, the absolute most boring asset on Earth, Japanese government bonds, has basically been the duct tape quietly holding the entire global financial system together. Let's trace this back. In 1992, Japan's asset bubble burst, which kicked off what we now call their lost decades. To fight off zero economic growth, the Bank of Japan eventually pushed their interest rates all the way down to zero. They even created something called yield curve control to literally superglue long-term bond yields right to the floor. And this went on for decades, right up until a massive turning point in 2024. Think about it like this. Imagine you're a giant Japanese pension fund. Your domestic bonds are paying you exactly 0%. So what do? Well, you go shopping overseas. Facing literally zero returns at home, Japanese investors went on this multi-decade global shopping spree. They bought out mountains of U.S. treasuries and mortgage-backed securities. Effectively, Japan just became the world's ATM. Section 2. The yen carry trade. Global Wi-Fi. Now, to really understand how that global ATM operated, we need to look at a step-by-step process called the yen carry trade. It's wild. Investors would borrow Japanese yen at basically 0% interest. Then, they'd convert that yen into US dollars and use those dollars to buy US treasuries that were yielding, say, around 4%. After a few minor costs, they just pocketed the spread. It was essentially free money. This single trade provided trillions in global liquidity. It was literally the Wi-Fi that global markets ran on, funding everything from the latest tech stocks to your local real estate market. Section 3. Bracing for economic impact. The unwind. But here is the catch. What happens when the math on that perfect trade suddenly flips? Remember that 2024 turning point? Well, after 17 long years, the Bank of Japan finally raised their interest rates, and boom. Suddenly, borrowing yen got a whole lot more expensive. The cost to hedge against currency risk just skyrocketed. That free money trade? Yeah, it wasn't free anymore. This triggered a massive unwind, as all that capital that had been flowing out of Japan for decades suddenly began rushing right back home. And you might be wondering, why does that matter to you and me? Well, as legendary investor Ray Dalio points out, the bond market is the backbone of all markets. It's the baseline interest rate that dictates what all other asset returns are going to be. So when Japan, who is literally one of the biggest, most reliable buyers of US debt, just stops buying, it creates this massive supply and demand imbalance that shakes the foundation of absolutely everything we invest in. The crucial takeaway here is that if Japan stops absorbing our debt, our yields have to rise just to attract new buyers. And when long-term yields rise, global liquidity tightens up. That leaves us bracing for some pretty serious economic impacts. We're talking about stock valuations compressing, 30-year mortgage rates staying pinned high, completely regardless of what the Fed decides to do with short-term rates, and corporate credit tightening up, which just drags down overall economic growth. Section 4. The math of wealth. The micro-defense. Now, I know, while global capital flows are flipping upside down in the macroeconomic markets, brace for impact, it's really easy to feel powerless. But this is exactly where you take back control. The $100,000 mark. That is your anchor. Understanding what happens at $100,000 is the absolute secret to surviving and honestly thriving in a tightening global economy. It's the launching pad for building your own personal financial fortress. To get to that anchor, we rely on compound interest. It's a super simple concept, but it's incredibly powerful in practice. It's just when your money earns a return and then those returns go out and earn their own returns. It acts exactly like a snowball rolling downhill over time. You got to think of it as transforming your dollars from just boring pieces of paper into little soldiers or employees who are working around the clock for you. And the best part, getting started is way more accessible than you probably think. Building wealth takes just $14 a day. Seriously. By investing just $100 a week, which, let's be real, is about the cost of one fast food meal or a couple of fancy coffees a day, at an 8% real return after inflation, you are setting the ultimate foundation for your defense. Section 5. 3 Phases to a Million. The Snowball. Let's break down the blueprint of how this actually builds across 3 very distinct phases. The contrast here is just staggering. Phase 1 is what we call the grind. It takes about 12 years of putting in that $100 a week to finally hit your first $100,000. And yeah, it feels exactly like pushing a massive boulder uphill. But then look at phase 2, the shift. Between years 12 and 18, your net worth doubles to $200,000 in half the time. During this phase, that compound interest line actually crosses your contribution threshold. Your money is officially outworking you. When we map out the whole mathematical journey, you go from phase 1, grinding out that first 100K with over $62,000 of your own hard-earned cash, all the way to phase 3. In phase 3, the snowball phase, you're doing almost zero personal heavy lifting. Instead, the market is just effortlessly handing you roughly $80,000 a year in growth, and you haven't even had to sell a single share. How crazy is that? By the time you cross that glorious $1 million mark at year 36, the breakdown is amazing. You've personally put in just about $187,000. That's only 18% of the final million. The market, purely through the magic of compounding, did over $800,000, or 82% of the heavy lifting for you. This ratio right here, it's the entire argument for why you need to start early and stay absolutely consistent. But there's a very human element to all of this that no spreadsheet can ever really capture. Crossing that initial $100,000 anchor creates a massive psychological shift. It's undeniable proof that the strategy actually works. It's kind of like stepping on the scale and finally seeing the results of a diet you've been on for months. This triggers a huge boost in motivation. It pushes you to make larger contributions, and it even drives you to scale your career income so you can push that snowball even faster. So, as we wrap up this explainer, we're left with one really vital realization. At the end of the day, you can't control the Bank of Japan. You can't control the unwind of the yen carry trade, but you absolutely can control your consistency, your savings rate, and your own financial discipline. So I'll leave you with this. While the global market braces for impact, are you ready to start building your personal snowball today to withstand whatever comes next?